If you're over 60 and you have money sitting in a retirement account, you need to hear this before making your next withdrawal. Most retirees believe taking money out of an IRA or a 401k is simple. You request the funds, the money lands in your bank account, and that's the end of the story. But what many people don't realize is that withdrawing $15,000 the wrong way, or without understanding the tax consequences, can unexpectedly attract attention from the IRS. And by the time many retirees realize there's a problem, it's already tax season and the damage may already be done. In this video, we're going to break down what really happens when you withdraw money from a retirement account after the age of 60, why a $15,000 withdrawal can create unexpected tax issues, and what you can do to protect yourself. Let's start with the basics. When you're working, your income usually comes from a paycheck. Taxes are automatically withheld before the money ever reaches your bank account. Federal taxes, Social Security taxes, and sometimes state taxes are taken out, so by the time you receive your pay, most of the reporting has already been handled. But in retirement, things work differently. Your income may now come from several sources. You might receive Social Security benefits. Some retirees receive pension payments. And many people rely on withdrawals from retirement accounts like traditional IRAs or 401k plans. Here's the key detail many retirees overlook. Money inside traditional retirement accounts has usually never been taxed. Contributions were often tax-deductible, and the investments grew tax-deferred for many years. But the IRS eventually wants its share. When you withdraw money from a traditional IRA or 401k, that money typically becomes taxable income for that year. And your financial institution reports that withdrawal to the IRS using a document called Form 1099-R. This means that even if you forget to report the withdrawal on your tax return, the IRS already knows about it. They have the record of the withdrawal, the amount you received, and the account it came from. If what they see doesn't match what appears on your tax return, it can trigger notices, questions, or additional taxes. Now let's walk through a simple example so you can see how this situation can happen. Imagine you're 63 years old and retired. You have a traditional IRA with around $200,000 saved. One day you decide to withdraw $15,000. Maybe you want to pay for a home repair, help a grandchild with college expenses, or simply take a vacation you've been planning. You request the withdrawal, and within a few days the money shows up in your bank account. Everything seems normal. But behind the scenes, your financial institution sends a Form 1099-R to the IRS reporting that $15,000 distribution. You'll usually receive a copy of that form early the following year during tax season. Problems can begin if that withdrawal isn't handled correctly when taxes are filed. For example, some retirees forget to include the withdrawal as income on their tax return. Sometimes the form arrives in the mail and gets overlooked. Other times, people simply don't realize it needs to be reported. When the IRS compares their records to your tax return, they may see a mismatch. Their system detects that a withdrawal was reported under your Social Security number, but the income doesn't appear on your return. That's when letters and notices can start arriving. Another issue happens when taxes were not withheld at the time of the withdrawal. When you request a retirement distribution, you often have the option to withhold federal taxes immediately. Some people decline this option because they want the full amount deposited into their bank account. But at tax time, the entire withdrawal is still considered taxable income. Depending on your overall income and tax bracket, that $15,000 withdrawal could create a tax bill of several $1,000s. And if the taxes aren't paid on time, interest and penalties can be added on top. There's also another effect that surprises many retirees. A withdrawal can increase your total taxable income for the year. That increase may push part of your income into a higher tax bracket. It can even cause more of your Social Security benefits to become taxable. So one withdrawal can sometimes create multiple tax effects that people didn't expect. There are also a few situations that tend to raise questions or red flags with the IRS. The most common one is simply failing to report the withdrawal on a tax return. Another situation involves required minimum distributions. Once retirees reach a certain age, currently 73 for many people, the IRS requires minimum withdrawals from traditional retirement accounts each year. These are known as required minimum distributions, or RMDs. If someone forgets to take the required amount, penalties can apply. Large withdrawals that dramatically increase income in a single year can also draw additional scrutiny, especially if other parts of the tax return appear inconsistent. None of these situations automatically mean something is wrong, but they can increase the chances of the IRS sending notices or requesting clarification. The good news is that most of these problems are completely avoidable. The first step is keeping good records of every retirement withdrawal you make. Write down the date, the amount, and which account the money came from. When tax season arrives, compare your records with the forms you receive from your financial institutions. The second step is making sure taxes are either withheld during the withdrawal or set aside for tax season. This helps avoid surprise tax bills later in the year. The third step is understanding the rules around required minimum distributions if you're approaching the age when they apply. And finally, many retirees find it helpful to work with a qualified tax professional who understands retirement income and tax planning. A professional can help you structure withdrawals in a way that keeps your taxes as low as possible and ensures everything is reported correctly. The bottom line is simple. Withdrawing money from your retirement accounts is normal. It's the money you worked hard to save over many years. But those withdrawals come with tax rules, and understanding those rules can help you avoid unnecessary problems. A $15,000 withdrawal isn't a problem on its own. The key is making sure it's handled correctly and properly reported. Staying informed and planning ahead can protect your retirement savings and prevent costly mistakes.